Big business versus small business versus the Federal Reserve. What's going on with inflation? How do these things come together? How do they combat against each other? And what impact is that going to have on the stock market? We dive into all of these subjects right now.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hey, welcome to the Trending Report, everyone. As usual, we will be diving into a tremendous amount of market data as it relates to the various subsets based on capitalization, based on the sectors, based on international, and taking a look at bonds as well. Our market data will be that which is through the end of the prior Friday, February 10th, but we will also be talking about what's going on with the Federal Reserve, the increasing of interest rates, where inflation is at, what's going on with the job market, how all of these things are impacting on what's taking place in the economy and the market. So with no additional delay, here we go. Now, first off, as you may have heard or seen in the media, there is a lot of talk from economists in the media about the purpose of the Federal Reserve and what it's trying to accomplish. So basically, the Federal Reserve has been increasing interest rates with the idea that that would slow inflation, but also needing to get the impact on inflation, they want to cool off the job market. So they actually literally want to increase unemployment. And in doing so, many are starting to argue that that is kind of working against some of the basic mandates. Seldom do I read to you here on the Trend Report, but I am going to just talk about this first paragraph from Time magazine here. It says, by the law, the U.S. Federal Reserve is supposed to be a champion of working families, instructed by Congress to aim for maximum employment and low inflation. But make no mistake, and they go on to talk about the central bank not being your friend. A growing number of economists are questioning this age-old approach in combating high inflation and whether or not it makes sense, primarily because, again, they're not trying to get maximum employment. They're specifically trying to decrease employment in order to have that impact positively on inflation. And when you look at the most recent jobs report, we've got, as of January, another 500,000 new jobs, pushing us to an all-time low since 1969 of 3.4%. So obviously, it's not quite working the way they wanted, although I will say that the inflation has kind of hit its peak and it's kind of curving down a little bit right now. Maybe not as quickly as they'd like, but it is essentially going back in the proper direction, so to speak. Now, many of you may have heard President Biden speak on his State of the Union not long ago. And one of the statements he made was about the fact that his administration had created more new jobs than any other administration prior in the history prior to his administration. Now, a lot of people took contention with that. And the reason is, it doesn't really matter which side of the argument you want to fall on, but the reasoning behind it is, if we're looking at United States unemployment, which is this chart in the upper left-hand corner, this is what was going on prior to the pandemic. And right here in early 2020, we were sitting at 3.5% unemployment. Now, you may have heard me say before that oftentimes economists will say anything below 4% is essentially full employment because a certain percentage of people simply don't want to work. So 3.5% was a historic low in its own right. And then the pandemic hits and the lockdowns take place, and we see unemployment skyrocket to almost 15% unemployment, like practically overnight. And since then, it has been kind of eroding or working its way back down. Now, as this has been under President Biden's administration, he wants to take credit for all of these jobs as if they've been created from anew, so to speak. Now, obviously, that isn't the case. We know that. However, today, right down here, we are back to the 3.4% unemployment that I spoke to a moment ago. So some would argue that President Biden or the Biden administration in general should really only take credit for the difference between 3.5 and 3.4, whereas they would prefer to take the difference between this high point of 15 coming down here to that 3.4. So it doesn't really matter which side of the argument you're on. That's where we're currently at. Unemployment is continuing to go down. Yet, the Federal Reserve is trying to get unemployment to go up because that will help bring inflation down and will allow them to eventually quit raising interest rates, ultimately cap that, and then hopefully start working back down the other direction. Now, a lot of people are also scratching their heads saying, how did unemployment go down when I'm reading about all these large layoffs? Well, the large layoffs are coming primarily from large corporate America and with an extra emphasis in the tech area. So Google, Meta or Facebook, Amazon, Microsoft, Salesforce, IBM, and so on make up the bulk of that list. And when you look at this graph in the lower left, you'll see right here, since the end of 2022 and going into 2023, look at all the layoffs in here, all the name brands that you see. Prior to that, we were seeing layoffs in 21 and 22, but not to the extent that it jumped up here in early 23. So again, how is it that all of these layoffs are taking place, yet unemployment is continuing to go down? Well, the reason for that is small and or mid-sized businesses. Now, small businesses are technically considered employees of less than 500 at a business, makes it a small business. But most importantly, there are 32.5 million small businesses, so it makes up a large percentage of the workforce. And they created a lot of jobs. In fact, they're saying annually it accounts for 64% of new jobs created in the United States, and they tell us that over 90% of business population represents small and mid-sized businesses. But most importantly, we look right here at this midpoint stat. What is the number one problem that small business is combating against? The number one challenge they have right now? It's quality of labor. So all of the small businesses who over here were impacted by COVID, shut down, reopened, and so on, a lot of those businesses that were heavily impacted by COVID happened to be skewed more towards small and mid-sized business. So the small retail stores, the small restaurants, the storefronts, and so on that immediately had to shut down under COVID. And now they've been getting back to operational standards. They've been trying to hire people, and it's actually easier to get hired in these jobs today than honestly ever I can remember. My older adult children were not able to get jobs that today my youngest child who's in high school is able to get because they simply will take just about anyone who is capable of coming in some of these storefront type or retail type roles right now. So a lot of that job creation is coming in at the small and the mid-sized businesses. Now, the question then becomes, well, how does all that impact onto the market? So we'll take a look, as you can imagine. From a U.S. capitalization standpoint, this means looking from large cap down to small cap. Where is the performance coming from? Well, right now, it's coming from everywhere. Look at all of these green dots. Everything green means it's tilting bullish, as we say. So everything from the high level macro, where it's a really high altitude view, down to the nano, where it's a very microscopic or close low altitude view. All of this is coming in green. We're seeing positive numbers on the tilt, which is kind of the overall scoring of all four of these nano, micro, meso, and macro viewpoints. And what you're seeing here is this blue bar in the middle. This is the overall stock market, and it will normally float around the middle. So the things above it are helping to buoy up the market. The things below it are tending to drag it down. And as you can imagine, based on what we just talked about from hiring, it's your small and mid caps that are driving the market up right now. And it is your large caps, the S&P 500, the S&P 100, that are bringing the market back down. So when we look at macro right here, bring this all the way to the bottom, look at all the red we were seeing here. And all of that red is this downtrend in the market that was taking place. And then here we've got this uptrend taking place, and this is where the macro went green right here. And we already see the tilt has gone green and the nano has gone green. So right here is your nano line, and the nano green started right around in there. So you can see that the shift or the tide does seem to be turning, and we are getting a lot of bullish signals across the board right now based on capitalization. Then when we look at sector, we see kind of similar, but right in here, we're seeing some red, aren't we? So we're seeing negative numbers on those that are below the equal weighting across all sectors. And again, keep in mind there are 11 different sectors in the marketplace, and the sectors that are kind of pulling us down right now, so to speak, are energy, healthcare, consumer staples, and utilities. Those that are buoying us up: telecom, information tech, financials, industrials, consumer discretionary, and then even down to materials and REIT, which is real estate. So a way to think about this then is that it is the small and mid cap versions of these sectors that are buoying us up. So small mid cap telecom, small mid cap information tech, small mid cap financials, and so on are kind of what's buoying up the market right now. Now we are seeing some red down in this area, not all green like we saw on the other, but overall, whether it's large cap through small cap, regardless of sector, we're seeing a bullish tilt right now. But we get a little different view when we go over to bonds. With bonds, we are still seeing a lot of green, but look what's happening on the nano. Look what's happening on our low altitude view of the bond market. We're seeing all solid red across the board. So the overall bond market here represented in the middle, which is this graph on the right, and here we're seeing basically corporate bonds are buoying up the bond market, and treasuries are dragging down the bond market right now. So again, if we're looking at macro down here at the bottom, all of this red is obviously depicting this downturn, and then we're getting some green here at the end. But this little spot right in here is the nano. And as you can see, the nano has turned red not too long ago. So we don't know if that's going to be a speed bump along the way. We don't know if that's going to grab hold and run across the board, or if it's going to move back in direction. So right now, for the last number of months, bonds and equities have kind of been moving in the same direction, be it up or down. Right now, this is starting to show that we might start to see a divergence in that, which historically has probably been more of a traditional case as of the last couple of decades. And then finally, let's take a look at international. Now, international, we're seeing kind of the similar scenario to bonds. From a nano perspective, we're seeing red. So low altitude, we're seeing red across the board, keeping in mind that the international bull tilt took off quicker than domestic, than the U.S. did. But now the U.S. is kind of taking that over. Now we see international nano turning red. So again, we don't know. Is that going to run across the board? Is this a snapshot of what's to come, or is this a speed bump along the way? Again, going to be yet to be seen right now. But internationally, again, you can see the overall market. We had a lot of bear tilt, red coming down here, and then the green has come back up. But right here, this very end little tip, we're starting to get flashes of red again. And once more, we don't know if international is going to be the leading end of the curve, so to speak, for domestic and U.S. Normally, U.S. tends to carry more weight, but as of late, it was international that turned green, started tilting bullish quicker, and then the U.S. followed. So now it'll be interesting to watch if this is the first tilt back the other direction. Is international going to lead that way, or is it going to be a speed bump along the way? A lot of it's going to depend on the Federal Reserve, what they continue to do with interest rates. They've been starting to minimize some of their increases. There is talk about slowing some of that down. However, they didn't get what they wanted in terms of the unemployment stats. They wanted to see unemployment jump up a bit more to support them slowing down the rising of interest rates, and to support them ultimately stopping the increase of interest rates before ultimately one day turning it back the other direction. That part didn't come through in the jobs market. So it's going to be interesting to see if we can continue to turn down inflation without having a negative impact on jobs. And that's yet to be seen, but we'll be watching closely, and we'll be back with you shortly to speak to this in greater detail. Thanks, everyone.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.